Palantir, you've heard the name, government surveillance, CIA funding, big data, but what does the company actually do? And how did a startup backed by the CIA grow into a $300 billion market cap giant? And why is it one of the most polarizing stocks on Wall Street? In this video, I'm breaking down Palantir's real business model, the products they sell, how they make money, and why everyone from the military to your favorite investors can't stop talking about them. I'll also address the all-important topic of whether or not Palantir is an investment-worthy stock, so be sure to watch it all the way to the end. No hype, just facts. Before we dive in, let me introduce myself. I'm Steve Reitmeister, but everyone calls me Righty. I spent over a decade as the editor-in-chief of Zacks.com, where my commentary was read by millions of investors. I'm currently a partner at WallStreetZen.com, where our quant team analyzes thousands of data points to help investors beat the market. If you want to avoid the costly mistakes most investors make with overhyped tech stocks, do me a favor, hit that like button. It tells me to make more videos like this in the future. Let's talk about the mystique of Palantir and why it just feels different from other companies. The name of the company comes from the Lord of the Rings. In Tolkien's world, a Palantir is a mystical orb that lets you peer into distant places, uncover hidden truths. Governments and big businesses face problems on an immense scale. You've got surveillance camera footage from thousands upon thousands of cameras, signal intercepts from communications, financial transactions in the billions, right? Personnel records, sensor data, emails, reports, and they're usually siloed, sitting in different separated systems that don't talk to each other. Now, Palantir plugs into all that chaos and says, here's what you're missing. Here's the connection between these three data points that reveals a terrorist network. Here's the supply chain bottleneck that's about to cost you $50 million. The company is deeply embedded in U.S. government operations, the CIA, FBI, NSA, and multiple branches of the military. When you have that level of access to the most powerful and secretive organizations in the world, you breathe both admiration and fear. Some people say that Palantir is a force for good, helping catch terrorists, uncovering fraud, and saving lives. Others see it as Big Brother incarnate, enable mass surveillance and predictive policing that could threaten civil liberties. Love it or hate it, Palantir isn't going anywhere. The real question is whether that mystique translates in sustainable profit growth or whether it's just an expensive consulting firm wrapped up in Silicon Valley hype. Let's dig into how this actually all got started. Palantir was founded in 2003 by Peter Thiel, Alex Karp, Joe Lonsdale, and Stephen Cohn. These are some heavy hitters, especially Peter Thiel, who co-founded PayPal and was the first outside investor in Facebook. He has a very specific worldview about technology and power, and, he usually gets it right. Their early funding came from In-Q-Tel, which is CIA's venture capital arm. When the CIA is writing checks, you're not building a regular consumer app. The mission was straightforward. Take the anti-fraud technology they built at PayPal, the stuff that could spot patterns in millions of transactions to catch bad actors, and adapt it to track terrorists after 9/11. And from there, the software spread throughout the intelligence community. Palantir didn't go public until 2020. That's nearly 2 decades operating in the shadows. They chose a direct listing on the New York Stock Exchange on the ticker of PLTR, and suddenly the secretive company that most people had never heard of was available to retail investors. Let's dig into what this company actually does, because this is where things get really interesting. So what does Palantir actually do? Palantir has 3 main platforms. First, there's Gotham, built for intelligence and defense agency. The military uses Gotham to identify insurgent networks by connecting unrelated data points, a cell phone ping here, a financial transaction there, a vehicle movement somewhere else. Individually, they mean nothing, but Gotham connects them and says these 3 things suggest a coordinated operation. That's pattern recognition that humans would never spot manually. Second, there's Foundry, their commercial platform. In May 2025, Fannie Mae, which holds over $4.3 trillion in mortgage assets, deployed Foundry to power their new crime detection unit. In an early test, it identified mortgage fraud in 10 seconds that took human investigators 2 months to find. They're now using Foundry to scan millions of loan files, detecting fraud patterns across financial transactions, property records, and borrower data that would be impossible to catch manually. Third, there's Apollo, the behind-the-scenes delivery engine. Apollo keeps Gotham and Foundry updated and stable across complex secure environments. This is critical for government clients operating on classified networks where you can't just push updates like a normal software company. These aren't nice-to-have tools. They're mission-critical systems where failure has catastrophic consequences. That's Palantir's sweet spot. All right, before we move on to the nitty-gritty of what the company's business model is, do me a favor, hit the subscribe and notification bell so you don't miss any of my future videos. Okay, let's talk about the business model and how Palantir actually makes money. Most SaaS companies sell cheap subscriptions. You sign up online, maybe pay a few $100 a month, and you're off the races. That's not Palantir. clear. Palantir sells big, expensive, sticky deployments. We're talking about long-term contracts with governments and large enterprises worth tens of millions of dollars, sometimes hundreds of millions. We keep track of Palantir's average deal value with its top 20 customers on our website. You can see the chart on your screen now, and since 2023, the average value of these deals has exceeded $50 million. These deals include setup fees, user licenses, and ongoing support, because what really makes Palantir different is their high-touch approach. They don't just hand over software and walk away. Palantir embeds engineers with clients for months and oftentimes years. These engineers customize the platform for the specific workflow. They integrate with your existing systems. They train your team. They become integral to your operations. And once that happens, you're locked in. Not legally, there's no contract preventing you from leaving, but practically you are stuck with them, because to switch to another platform, you need to rip out all those customizations, retrain your entire team, migrate terabytes of data, and rebuild all your workflows. For a government defense agency, that's 18 to 24 months disruption. For a Fortune 500 company, same story. That's economic moat. The switching costs are massive. As you can see from the revenue page on WallStreetZen, 50% of the company's revenues comes from government contracts, defense, intelligence, civilian agencies. The rest comes from commercial clients in healthcare, finance, manufacturing, energy, and so on. In 2020, government contract revenue truly took off, and the gap between the two categories has only widened. Palantir has also started actively investing in startups. They take an equity stake and become the startup's primary data platform. They're gambling on the startup's success while guaranteeing themselves a customer. If the startup grows, Palantir wins twice, once on the equity appreciation and again on expanding software revenue. So that's the business model. High-value contracts, deep integration, massive switching costs. It's why the revenue is so sticky and why commercial customers are expanding spending by 20 to 30% per year. Let's switch gears and talk about Palantir's many controversies. A lot of what the company is involved in has attracted some negative media attention. For example, Palantir's work with ICE and law enforcement agencies has sparked a massive backlash. Critics argue that their technology enables mass surveillance and predictive policing, tools that can be used to track immigrants, build profiles on citizens, and make arrest predictions based on algorithms that many believe to be biased. When you're giving governments the power to connect every data point about a person's life, where they go, who they talk to, what they buy, civil liberty advocates get nervous. There are also legitimate concerns about algorithmic bias, about who gets flagged by these systems and whether we're building a surveillance state one contract at a time. Then there's the secrecy problem. For years, Palantir operated like a shadowy tech network. They avoided the press. They rarely disclosed customers. They thrived in that ambiguity. That built mystique, but it also built suspicion. Are they building Big Brother? And if they are, would we even know about it? Now, here's Palantir's defense, and you can decide if it holds water. Their position: these are tools that amplify human decision-making, and the responsibility lies with the users, not the platform. They emphasize audit logs, data controls, and oversight mechanisms built into their platforms. Everything is traceable. Everything leaves a digital trail. Whether you buy that argument depends on your values, but for investors, the controversy isn't going away. It shapes how Palantir is perceived, who will work with them, and what regulatory scrutiny they will face. Now it's time to look at the numbers, because love it or hate it, Palantir has become a very profitable company. Palantir went public in September 2020 to a direct listing at around $10 per share. The AI and government tech hype pushed it to 35 by early 2021. Then it crashed during the broader tech sell-off, falling back below 10 at one point. This is a classic hype cycle falling apart. But here's where the story gets interesting. For years, Palantir burned cash like it was going out of style. The culprit? Stock-based compensation. They were handing out equity to employees like candy, which inflated losses on paper even as revenue grew. Bears hammered them for it, saying they'd never be truly profitable. Then in 2023, something changed. Not only did revenue exceed $2.2 billion, more importantly, they proved they could generate real profits, not just accounting tricks. And then came the S&P 500 inclusion in September 2024. That's a huge milestone. Index funds are now required to own Palantir stock. Institutional investors who couldn't touch it before are now buying it. It brings legitimacy, visibility, and more stable demand. But the real story is the commercial growth. U.S. commercial revenue surged over 100% year over year in 2025. That's massive. And it proves Palantir isn't just a defense contractor anymore. They're winning real enterprise customers like banks, manufacturers, energy companies, and healthcare systems. If they continue to execute, this could be a generational software company. If they don't, this could be another painful lesson in overpriced stock. In 2023, Palantir launched AIP, the Artificial Intelligence Platform, and this is what the entire valuation debate hinges on. AIP integrates large language models, think ChatGPT-style AI, into enterprise and defense settings. Instead of just chatting with AI, you're asking it questions about your actual data, and it gives you actionable answers. A military commander could ask, where should we position forces to prevent ambush attacks on resupply operations this week? The system generates a risk map based on battlefield intelligence, logistics data, and historical patterns. An operations manager at a manufacturing company can ask, what are the biggest supply chain risks this quarter? The ERP runs simulations based upon the real-time data from the ERP system, supplier networks, and market conditions. Then it gives very specific recommendations. AIP runs on your data, your company's data, your agency's data, not the open internet. That means it's secure, private, and is trained on information that's actually relevant to your specific operation. Now, Microsoft, Google, and Amazon might have better language models, but Palantir has something they don't, which is deep integration with the most sensitive, mission-critical systems in the government and corporate enterprises. If you're the Pentagon, you're not uploading classified intelligence to ChatGPT, but you might use Palantir's AIP because it runs on your secure network with your data. If you're a bank dealing with fraud protection, and you're not going to send all that customer financial data to OpenAI, but you might use AIP once again because it stays safely inside your firewall. Palantir is positioning itself as the AI infrastructure company for organizations that can't afford to take risks with data security. If this pivot works, it could be worth multiples of what it is today. If it doesn't work, meaning if AIP is just hype and commercial growth stalls out, then the current valuation is a serious problem. So, should you actually buy this stock? At WallStreetZen, we built our own in-house quant rating system. It takes 115 different metrics split across 7 different categories for a holistic overview of any given ticker's fundamentals. It updates for over 4,600 stocks every single day. Where does Palantir rank? Well, it's in the top 22% of all stocks that we look at, which is not bad, but it's not great because the devil's in the details here. Let's go through both the bull case and the bear case for Palantir, and we'll supplement that with the appropriate metrics as we go along. The bull case goes like this. Palantir has a unique market position. They serve both government and enterprises with mission-critical software that's extremely hard to replace. Once you're embedded with Palantir's engineers and they've integrated into your systems, ripping that is an absolute nightmare. And margins are improving. Plus, they're riding a massive secular wave in that every organization on the planet is trying to figure out AI and data analytics. Palantir is positioned right in the middle of that soaring trend. Bulls also point to the retail investor following. Palantir has a cult-like base of believers who see this as a generational software company, potentially the next Microsoft. And with the S&P 500 inclusion, institutional money is piling into the stock as well. When it comes to our growth factor, Palantir ranks in the top 7%, which is truly great. It's also gotten Wall Street seal approval. In fact, right now, the average price target from analysts implies an upside of 40% for the stock in the year ahead. Now let's consider the bear case. Every customer needs a team of forward-deployed engineers for months. How do you scale that? You either hire thousands more engineers, which is expensive and dilutes the culture, or you build more self-service tools and become just another software vendor. Either way, you lose the economic moat. There's also concentration risk. Over half the revenue comes from government clients. What happens if there's a change in administration leading to budget cuts? And what if geopolitical tensions ease and defense spending drop? And then there's a serious valuation concerns. Palantir has recently traded over 110 times revenue, sometimes even higher. That kind of sky-high valuation often assumes near-perfect execution where one stumble could topple the stock. It assumes AIP becomes used. It assumes commercial growth reaccelerates. It assumes margins keep expanding and stock-based compensation keeps declining. Rating systems say about the valuation, bottom 13% of all stocks. That's truly brutal, right? Any misstep, like a bad earnings report, a major contract loss, or a slowing customer adds could easily trigger a massive sell-up. We've seen this stock drop 50% before. It could absolutely happen again. If you believe in the bull thesis and you can stomach the volatility, there's a case to be made to own this stock, but if you're risk averse or looking for value, this is absolutely not the stock for you. Another approach is to look for alternatives that rate higher in our Zen rating system. For instance, when you open a Palantir stock page, you'll see that it's only the 29th ranked stock in its industry. And right now, there's over 20 stocks in their industry with much more favorable A and B Zen ratings. This points to much higher odds of outperformance than Palantir right now. But if you want a faster jumpstart and some great investing ideas, then check out my special report featuring 3 stocks I believe could double or more in 2026. Either click the link in the description or scan the QR code to get your free copy of the report. Companies like Palantir, controversial, polarizing, with cult-like followings and sky-high valuations, they either become the next Microsoft or they become cautionary tales of what not to do. There's not much middle ground. The growth trajectory makes me curious, and the switching cost gives them a serious economic moat. Unfortunately, the nosebleed valuation make me nervous because you are betting on near-perfect execution. That's not a bet I'm making today, but we'll continue to watch closely. Now, I want to hear from you. Are you bullish or bearish on Palantir? Just drop a comment below and let's have that conversation. And if there is another company that you want me to break down like this, post that in the comments as well, because I read every single one of them. Right now, I suggest you keep your education going by checking out my video about how to use cutting-edge tech to find better stocks to buy now.